So right now, prices are down and the fear is up a little bit. But nevertheless, the biggest funds in the world are quietly buying apartments at a discount. So in this video, I'm going to show you why right now might be the best time in like a long time to get started with multifamily real estate. And I'm going to share with you why prices are actually down 20 to 40%, how we got there, and why the demand for affordable housing is only getting stronger. But it's not just a market update, because if you want to build wealth with real estate and actually scale, you can't keep doing it alone. And you need a team and you need the right strategy for this moment in time. So stay with me until the very end, because we're going to connect the dots and you're going to see exactly why this might be your window to financial freedom. Now, there's also another reason to get started in your journey right now. Okay? Making a decision between comfort and freedom is very important. But there's another reason to get started right now, besides now being always the right moment to get started. Right? Why put it off for another year or two or three? If you want something that's good, why not get started with you now? But there's another thing that's going on right now, and that is what's going on in the market. And so I get this other question. It's the last question I'll answer here on this training is now the market right? Because the market changes all the time. So you might be wondering, is now a good time? Should I wait? What's going on right now? So let me ask you this. What have you been hearing about the real estate market, about housing, multifamily, office? There's overall negative sentiment, okay? And so there's a lot of fear and uncertainty in markets. So even with strong inflation and unemployment data, the Federal Reserve, for example, has hesitated to lower interest rates. And real estate's been in the news, and it's not a good way. Home prices have been going up. Housing is less affordable than ever. Bad. Most office buildings are for foreclosure. Even some apartment buildings, also bad. But is it possible that fear and uncertainty mean that there's some opportunity somewhere? Is it possible? And so let's see what Warren Buffett has to say about this. And I love this quote here: be fearful when others are greedy, and greedy when others are fearful. Who has heard this quote from Warren Buffett? Type yes in the chat. Yeah, this quote is always true, but it's particularly true right now. Because while there's a lot of fear and uncertainty in the market, private equity funds are quietly investing billions in real estate. So here's a recent article in the Wall Street Journal. Brookfield has raised $14 billion, that's billion with a B, to buy distressed real estate. And they already invested a quarter of that, $4 billion, in real estate, most of it in apartment buildings. And why would they do that? What do they know that the market at large does not? And one clue is in the article itself. Barron said prices are well beyond what it would cost to replace the assets. And this is important, they're 20 to 40% below what the properties traded for at their peak in 22. So what's really going on? And might this be a buying opportunity, not just for a $1 billion hedge fund, but also for us? So I'm going to take you on a journey. In order to understand why prices are down 20 to 40% from their peak in 22, we first have to understand why they were so high in the first place. So there's three main reasons prices were at their peak in March of 22. The first one is that we had historically low interest rates. As you probably already know, the lower the cost of capital, the more you can pay for a piece of commercial real estate in order to get the same rate of return. So you have to understand that investors are looking for the same rate of return regardless. They don't care what's going on in the market right now. They really want the same rate of return. So if the cost of capital is lower, I can pay more, and the investors get the same return. If the cost of capital is higher, I can pay less, so I can get the same return to the investors. So therefore, with interest rates at near 0%, you could pay more for the real estate and still get a 15 to 20% average annual return for the investors. Super cool. Now, at the time, not only were interest rates very, very low, lenders were giving us an extraordinarily high level of leverage, typically 80% loan to cost. Now, what loan to cost means you can get 80% of the purchase price, 80% of the closing costs, and 80% of the construction costs. Very high, right? Typically, as you may know or surmise, the more you can borrow, the less equity you have to put into a deal, and the less equity you need to put it in, and the higher the return on that equity. So, for example, if you could borrow 100% of the purchase price, you could have an infinite return. So the more you can borrow, the higher the return on the money. But it also means it's more risky. Now, the third factor why prices were so high in early 22 was market sentiment. And Warren Buffett called it greed. You can describe it as frothy. Yes, greed was the prevailing emotion, but the market was really frothy. Everyone was getting into syndications. And you put all this together, and you can see that the risk in getting into the market at the time was on the higher end of the risk spectrum. Now remember, With a multifamily, it's on the lowest end of the real estate investing spectrum, like we talked about in the earlier training. Within that lower end of the spectrum, there's also a spectrum, right? So 2.5, 3 years ago, it was on the higher end of the spectrum because we're historically high in low interest rates. The prognosis was going up. We had very high leverage, and everyone was jumping in, right? So interest rates were low and projected to go up, and therefore prices were bound to go down. Now, why are prices now 20 to 40% down? What happened? Well, three things. So in a normal market, had interest rates increased normally, everybody knew that interest rates were going up. Everybody in our analysis had higher interest rates, right? This wouldn't have been much of a problem. Prices would have slowly gone down in response to the interest rates, and the market would have adjusted. But what happened instead was this unprecedented inflation, lots of it. And as you now know, the Fed responded with raising interest rates 11 times in a row, unprecedented in the history of the world, something no one could have predicted. And so not only did the cost of capital increase a lot, which of course decreases prices, we just talked about, but that what also happened is that the market panicked, such that lenders stopped lending, including to multifamily. Lenders that were previously lending 80% loan to cost wouldn't lend more to they wouldn't lend more than 65% loan to value. 65 loan to value means that you're borrowing 65% of the purchase price. You're not getting a loan on the closing costs or the construction. You're getting only 65% of the purchase price. Okay? And that was a huge drop in loan proceeds, and that is because the market panicked. So, which means that if you wanted to buy anything, including a multifamily property, you know how to raise a lot more capital to do so. And remember that the more equity you need, the lower the returns on equity, which means that you can't pay as much. Prices dropped, right? Because investors always need the same rate of return. And then all of this created fear and uncertainty in the market. Lenders pulled back. Business stopped hiring and investing. There was blood in the streets, and no one knew when it would end. So sales of multifamily, the volume of sales declined by 81% over a 6-month period because sellers were still up here and buyers were down here. Like, hey, buyers, the guys, look, the interest rates are way higher. Okay, the leverage is much lower. Therefore, the price, the market is here, and you guys still want what you want in March 22. And all of this contributed to what we're seeing now, a 20 to 40% decline in prices over the past 24 months. Now, okay, be that so. Now we understand what happened. Now, what is the outlook for multifamily real estate? Now, the consensus is that interest rates are going to remain flat or go down slightly. Now, if Trump had his way, he'd fire Powell and make the Fed reverse all the interest rates and go back to where it was. But who knows if that's going to happen? Let me just say this about high interest rates in general. They're not actually the problem because you just incorporate it into your analysis. When you're buying, well, you put in 7%. Okay, that's it, your analysis. Therefore, I can't pay as much as when I had 3% interest rates. So high interest rates alone are not the problem because you adjust how you analyze deals. Now, the point is this. Interest rates are likely to remain stable and may go down somewhat. And if interest rates remain somewhat stable or go down a little bit, it decreases the risk for lenders who are likely to start lending more. So the leverage is going to go up. We already started seeing this. In the past year, the loan proceeds have slowly increased from 65% loan to value to about 75% loan to value now. We're still not getting financing for construction. That'll probably come sometime in the next 12 months. It's slowly starting to go up because the risk is starting to get squeezed out of the market. And so we have stable interest rates, which will slowly increase the leverage we can get, which will slowly start to increase the prices. But we're also going to get a much more balanced market. And that means that neither a seller or buyer's market, you get a much more balanced market. Now you got to remember, in March 22, it was a bear to buy stuff. It was a seller's market. Sellers got more than the asking price. They demanded and got non-refundable deposits. It was nice to be a seller in 22. We actually sold a bunch of stuff in 22, and it was awesome. Now, that pendulum swung to the complete opposite once interest rate hikes started, and no one was buying multifamily, even though sellers wanted to price from in 22 while the market is still 20 to 40% higher. So as a result, sales volume dropped by 80%, and no one could sell anything anymore. Now, what's happening is that sellers who want to sell have started to drop their asking prices, and buyers have started to come back to the market, and they're starting to buy, but at much lower prices, of course. And there's a lot less buyers. And those buyers are no longer having to put down non-refundable deposits. This is what I mean by there's a much more balanced market. That there's a much better chance of getting deals done right now. Much less competition. And also, what the outlook is that there's going to be a strong ongoing demand for multifamily real estate. So that's the outlook right now, but the ongoing demand is very important that you understand it because, like I said, I want a long-term vehicle to build wealth. So why am I saying that there's strong demand for affordable housing? The first reason is that for many years, we have had a huge housing shortage. This is the report from Freddie Mac from late last year. And it says in the highlights, says despite adding 5.8 million housing units over approximately 4 years since our previous estimate, they don't do it a lot, housing demand has increased by almost the same amount, resulting in very little progress in reducing the housing shortage. In the aggregate, we estimate that U.S. housing stock is still 3.7 million units below what is needed given our current population. So we added 5.8 million units over the past 4 years, but the demand for housing grew by about that much, and so we still have a giant shortage. That sucks. But we have another problem, housing affordability. The high interest rates have dramatically increased the cost to own a house. It's now nearly $1,100 more per month to own the same house as it is to rent it. Now, historically, which is the black line, the black loan you see here, it's normally 14% more to own a home versus renting it. But currently, it's 44% more to own than to buy. Now, for home ownership costs to return to the historical 14% average, mortgage rates would have to fall to 3.75%, essentially where they were before, assuming all other factors remain the same. So this giant gap between the super high cost to own a home and the rent is going to drive demand for more affordable rental housing because it's too daggone expensive to own a house. So what's the solution, right? Well, one would be for interest rates to go down a lot, and this may or may not happen, but it's not likely to happen very soon. And two is to build more affordable housing. That would be a good solution. But that's not likely to happen soon either. This is a graph of the permits that have been pulled for new apartment buildings. Now notice the huge decline over the past 18 months. So we're like all the way in 2025 on the right here, and this giant just dropped off the cliff. Now why is this happening, right? Why is this happening? And it's, look at this quote here from the bottom from Redfin's senior economist. He says, builders are pumping the brakes because elevated interest rates are making many projects prohibitively expensive, which could lead to an increase in rents. So bottom line, it's too expensive to build stuff, and developers can't make money anymore. So we have a significant housing shortage. It's much more expensive to own versus rent, and it's too expensive to build new apartment buildings, which means there should be very strong demand for affordable rental units, and with that, rents and prices should go up. Now, is that actually happening? Well, let's look. The answer appears to be yes. This is a chart from Yield Pro magazine, which provides up-to-date news and information for multifamily industry. In this graph, you can see the huge price decline since March of 22, which we've been talking about. But you can also see here, in this where this green area is, that where prices kind of dropped off, and now they're starting to go up a little bit, right? So prices have actually been slowly going up since February of last year. They're going up slowly for the reasons we just mentioned. But there's still this gap. We're still 18% on average nationally under where that peak was. In fact, just to drive this from the home, this Waverly Manor Apartments that we bought recently in Nighthawk, the 61 unit in Norcross, Georgia, the one I mentioned before, we got it just for under $9 million, but the same building would have been worth $12 million 3 years ago in 2022. That's a $3 million discount from the top of the market. Now, just because you buy something that's worth less than what it was before does not make it a deal by itself. The numbers still need to work in today's markets, and a deal has to stand on its own in a market with higher interest rates. I get that. But my point is that prices are down significantly from the top of the market, and the outlook for multifamily is vastly different than it was and very strong than it was in 2022. So let's put this all together here today. We have a significant housing shortage, and it's much more expensive to own versus rent. And it's too expensive to build new apartment buildings, and that means there's going to be strong demand for affordable rental units. That's very good for apartments. Now, I'm going to have stable to lower interest rates. I have a stabilizing market, and that means I'm going to have higher prices, but just because of that. But prices are still 20% below their peak, right? And so what this means is we have low prices, fear, but high demand and projection for higher prices. And that's why I believe we are in a 12 to 18 month window for a rare, once in a decade buying opportunity, right? So who here wants to take advantage of this opportunity? Because this is really, I think, going to be the biggest wealth creation moment we have here in recent history. It feels a lot like 2008 for me, except that no one knows about it. All right, so we're going to wrap this up here. In today's call was all about the breakthrough to financial freedom. It's about the scaling mindset and the shift that's required to scale if you want to become financially free. So we start off by showing that multifamily is just hands down the fastest path to financial freedom. We walked through the math to prove that just 1 or 2 multifamily deals can produce more income and wealth than a decade of buying rentals or grinding it out in your job. Do you see that now? Type yes in the chat box if you see that multifamily is the fastest path to financial freedom. But we also talked about why people never scale, even if they know multifamily is better. And it all comes down to mindset, because most investors try to scale using the same single family thinking and tactics that got them this far. And that's exactly what keeps them stuck. So you have to develop a scaling mindset. That's the secret to scaling, right? Do you see why you need a scaling mindset to scale, right? Type yes in the chat box. And at the heart of a scaling mindset is the realization that if you want to scale, you need to build a team. We talked about building the right team, your spouse, professionals like brokers and attorneys and lenders, the right property manager, and most importantly, the right partners for capital and deal flow. And scaling is not about doing more, it's about doing it differently and better, more, and smarter. So do you see why building a team is so critical? Type yes in the chat. If you want to scale, you need to leverage a team. It actually makes everything easier, even easier investing in single family houses. And then we just talked about why right now is a once in a decade buying opportunity. Prices are down, interest rates are stabilizing, and demand for affordable housing is only growing. And this window of opportunity is open, but it won't stay open forever as well. All right, so here's what we covered, right? We looked at what's really happening in the market, why prices are down, why demand is very strong, and why this might be an incredible buying opportunity, probably the best since 2008. But more importantly, we talked about the mindset shift required to scale, and why building a team is the key to doing bigger deals faster with less risk and, frankly, more fun. And with that, we're going to start module 3 of this training, because I'm going to walk you through the exact steps to do your first large multifamily deal, even if you don't have the money or the experience. We're going to get much more tactical now in the third part of this training. We're going to cover how to raise capital, how to talk to brokers, how to analyze deals, all using other people's money. So definitely let's start part 3 as well. And if you're serious about getting your first deal done and you want our help building your team, accelerating the process, then book a free strategy session with one of our advisors as well. All right, so with that, let's get into module 3 of this training. I'll see you there.